Hey everybody, Boz here. Welcome to the Financial Accounting Series. This is lesson one, and without further ado, let's get at it. In this lesson, we're going to learn how to define the term financial accounting, identify its uses, identify the four types of financial statements and also their major components, and then recognize how and why financial statements are prepared. Finally, we're going to describe the concept of corporate governance and describe how financial statements can impact stock prices. So, to start off with an example, let's say you have a friend who has his own business selling t-shirts to college students, and on the surface, his business seems quite profitable. He can buy the shirts for $5 a piece from his supplier, sell them for $15 a piece, so there's $10 of profit. And your friend is looking for you to maybe invest with him. Well, you might want to understand what other costs might your friend have. You know, he could have things like storage and advertising and inventory and shipping and taxes, and all of those costs are going to make the profit seem less and actually will be less than that $10 per shirt. So when he comes and says, hey, do you want to invest in my business? You're going to have some questions for him. You might say, well, like, what have you had for sales in the past? What do you expect for sales in the future? Those would be cash inflows. And then, can I get a summarized listing of your expenses? We see some examples, but let's put some actual amounts to here. Those would be cash outflows. Now, if your friend provides you with a printout showing his sales and expenses for last year, that might be a good start. You might get some understanding, but when you think about additional questions you might have, you might want to look at more than just one prior year. You might want to look at how the current year is going. You might want to look at future year forecasts, and then also proof that whatever he showed you is real and that he's just not inventing this to try to get you to give him some cash. You know, what else might you want to know? Well, we could look at this investment and we want to see, well, what are the potential risks in this investment versus what kind of returns can I get, and compare that to other things we could do with our cash. And those would be types of questions that you would go through before deciding to invest in your friend's business. In order to do that, financial accounting information can be helpful. Now, the term financial accounting, when we think about that, it's using an established set of rules to prepare financial statements for external users. So we've got rules, we've got financial statements, and external users is a key that way, not internal users, but external. We think of accounting, oftentimes accounting is described as the language of business. It is putting some information that we can understand to business activities. Oftentimes we are quantifying it, we are measuring it, and then communicating it. Financial statements, those are reports that are summarizing the financial information of a business. So the language is summarized into financial statements, and they're going to be using established rules. In accounting, we call those generally accepted accounting principles. Most folks in the field will just simply say GAAP, the GAAP. The external users. When we think about external users, we're thinking about shareholders, people that might invest in the equity of this organization, or creditors, people who might make a loan to the organization. So again, shareholders or investors, they're going to give up their resources, usually cash, to this business in exchange for ownership. You know, individuals, we oftentimes think of individuals just making these investments, right? But other times it can be institutional investors. That is a group of, oftentimes, some sort of professional money managers that would make investments on behalf of others. These could be mutual funds, where people effectively come together and pool their money and give it to a professional manager who will go out and buy a variety of investments. And then endowments. I'm a university professor. Our university has an endowment. Some of the biggest endowments in the world at places like Harvard, Yale, and so forth have tens of billions of dollars that they have been given, and then they invest that money and hopefully earn returns and take a portion of that to supplement their operations of the college each year. Two expectations of shareholders. They want dividends, and then they also want their investment to go up. Dividends used to be more popular. If we go back decades ago, it was just kind of a consistent stream of income, taking cash out of a business. Now people, it's so easy to trade stock right now that people are usually like, yeah, I will, give this company my money. Maybe it's not even going to pay me a dividend, but if the stock value goes up and I can trade it, I can make my money that way. That works for stock that is easily traded. Now, creditors, those are people who are going to give resources, usually cash, to a company in exchange for the promise of repayment. We oftentimes refer to these as loans. That can also be bonds, loans from banks, bonds held by bondholders. There's two expectations. People want to get their money back, and they also want to get interest on top of that. All right, I like to do a variety of review checks in this video here, quick review questions. So I encourage you just to read it and then come back and see if you can get the right answer. But who is not a primary user of financial accounting information? So when you look at that, what do you think? All right, well, an incorrect answer is creditors. Creditors absolutely look at it, deciding whether or not they're going to make loans. Investors absolutely look at accounting information when they're deciding whether to invest money into the company. Shareholders, they absolutely look at it when financial accounting information when deciding whether or not to purchase stock. And then managers, that would be the correct one. Managers are usually going to use what's called managerial accounting information. It doesn't have the same established set of rules. It's more best practices, and that would be the subject of a different course altogether. Investors is that more broad word there. I think of people, when I think of investors, I think people usually are thinking of shareholders that they're buying equity, but you can make an investment in a company through a loan. So investors is more the broad term, and then shareholders invest in stock, creditors invest by making loans. All right, so the four types of financial statements and their major components. What we have here is a balance sheet. And for a real company here, we'll talk about that in a moment. It's going to measure the financial condition of a company at a point in time. The key equation is going to be assets equals liabilities plus stockholders' equity. So that's a key one that you have to hammer home. Assets, resources a company owns. Some people just say stuff a company owns. Cash, receivables, inventory, property, equipment, and so forth. All right, those are the assets. Liabilities are amounts a company owes. So those could be accounts payable, wages and taxes payable. This could be debt. There's a lot of different types of liabilities. And then stockholders' equity is oftentimes the toughest one for people to wrap their arms around. They get that assets are stuff a company owns, liabilities are are items that a company has to pay back. Equity is the difference. It is what amount basically do the owners have as a claim to the company. I sometimes think about it as what amount did owners put into the company, usually via in cash, that they have not yet taken back out, and then that has to be adjusted by profit. So what is their investment in the company, plus or minus any profits, and then also subtracting what they might have already taken out. This is Lululemon. All right, so Lululemon, $7.1 billion worth of assets, $2.9 billion worth of liabilities, $4.2 billion worth of equities. You'll notice that total asset line of 7091941, that means 7.1 billion, because up top it says that everything's in thousands. If that is the same as liabilities plus equity, 7091941 at the bottom, 7.1 billion. All right, the income statement for Lululemon. This one is not in thousands. Companies can just choose to however they want to depict their information. So why Lulu decided to do the balance sheet in thousands and the income statement not, I guess we'd have to ask them. But that's $9.6 billion of revenue. It's in the most recent year. If we're looking down, and we'll highlight that in a sec, but it's going to show a company's performance over a period of time. Revenues minus expenses equals net income. So revenues, we think about those as increases in assets from ongoing operations. Basically a company is selling goods, providing services in exchange for most commonly cash or the promise that it's going to be cash at some point in time. So there's their revenues of 9.6 billion. You can see they've grown over the years. Now expenses, their decreases in assets from ongoing operations. Some of the common ones are their cost of their inventory, frequently referred to as cost of goods sold, salaries, interest, taxes, and there's a lot of others. Revenues minus expenses, that's what's going to give us net income. They don't have like Lulu did not have a line that just said total expenses, so that's why I didn't highlight it on this sheet. They just do have a variety of expenses listed. Lulu has 9.6 billion of revenues, 8.1 billion of expenses, 1.5 billion of profit. So it's important to know the income statement resets every period. The balance sheet is for a point in time. The income statement resets. So for the year that ended in 2022, they had 975 million of income. In 2023, it was 854 million, and then in 2024, it is 1.5 billion. So they've grown over time. So that is for a period of time. It resets each year. One other just kind of quick thing, and we could have noticed it on the balance sheet as well, but you see they're not using like December dates here for the year. A company can pick its year end. Retailers oftentimes will pick January 31st, so they kind of get through the holiday season. They get through all the returns. It's the end of a natural business cycle for them. So the balance sheet in the previous slide was for a point in time. The income statement is for a period of time. Now, the statement of stockholders' equity of the big four financial statements, of the four financial statements, I guess I should say, people probably go to this one last, but it's gonna. Sometimes you can glean what you need out of it. Sometimes you can just glean what you need by looking at the balance sheet. But it measures changes in equity over a period of time, and its key components. You've got common stock and additional paid-in capital. These are amounts contributed by the owners. These are collectively referred to as contributed capital. So contributed capital, common stock, and additional paid-in capital. They also have retained earnings. That's basically profits that the company has earned that it has not paid out as dividends. Sometimes this can be a loss too. Key equations: beginning contributed capital plus any stock that was issued during the year, minus stock repurchases. That's going to get you to ending contributed capital. And established companies usually don't have a lot of stock issuances, but they do have stock repurchases. So oftentimes contributed capital goes down year over year. And then beginning retained earnings plus income minus losses minus dividends is ending retained earnings. Oftentimes a good healthy company will have net income, won't pay quite all of it out in dividends. It'll reinvest some of it. So retained earnings tends to grow over time. So just some highlights, and they have some unique things on here as well, but we can see that they came, this is meaning that they came into the year with 3.1 billion of stockholders' equity. The end of last year is the start of this year. So 3.1 billion. They had 1.5 billion of net income. They have, I want to skip the next four line items. Those are getting pretty narrow. They have something called repurchase of common stock. That's going to be a concept that comes much later in the course, but that's just a company having excess cash. A lot of companies might pay dividends with that. Some companies actually choose to buy back their stock from their shareholders. So that was a decrease to stockholders' equity because they repurchased some from their stockholders. So their ending balance in stockholders' equity, 4.2 billion. The statement of cash flows, it summarizes cash flows going in and out of a business over a period of time. And the key equation in this one, we look at cash at the beginning of the year, and then we add to it cash flows from operating, investing, and financing activities, and that gives us cash at the end of the year. And sometimes it's not like those are all positives. So operating activities, hopefully it's positive for an established company. That's cash flows from operations. And we can see that Lululemon, if you look at that over the year, that is 2.2 billion of cash generated from their operations or operating activities, and that is bigger than their prior 2 years. Investing activities, purchasing or selling of long-term assets, and a good, healthy company usually has a negative here because it means they're expanding and growing like Lulu is. So if you look at the most recent year, that's 654 million that they spent on investments, and most of those are just buying new equipment and buildings. Financing activities, transactions with owners and creditors. We can see for Lulu, it's a negative, and in the most recent year, it's a negative 548 million. They're repurchasing stock, so they have extra cash. Lulu's in the position where they have extra cash. They don't know how to invest it all. When I say they don't know how, it's just that they don't have necessarily a good investment right now that they can think about. They're making some investments, but they still have extra cash. So then companies decide whether or not to pay a dividend or whether or not they're going to repurchase stock. That's a much later lesson, and they've actually bought stock back from their shareholders, and that's going to then give them the reconciliation in their cash during the year. They increased cash by a little over $1 billion during the year, and that's why their cash balance went from $1.1 billion to $2.2 billion. So the review question 2. Look at this for a moment. See if you can figure this one out. Which of these is not one of the 4 primary financial statements? So what do you think? Well, balance sheet's incorrect. That's a big one. Income statement, incorrect. That's a big one. Statement of cash flows, incorrect. That's a big one. Inventories itself is not a financial statement. It is a component of a balance sheet. All right, the next section, recognizing how and why financials are prepared. Sometimes I just use the term financials. That's kind of short for financial statements. So most businesses are private. They are not required to prepare financial statements. If you've got a local restaurant in your town, if you've got a local coffee shop, things like that, these are probably private businesses. They don't have to have financial statements at all. Now, once a business becomes publicly traded, it's required to prepare financial statements. And to be publicly traded basically means that they've gone through a process to allow their shares to be freely traded. This is a legal process. It involves government regulators as well. There are, other non-public businesses, they could issue financial statements. The most common thing would be is if they wanted to get a loan from the bank. And even though then it might not be required by a government to have financial statements, the bank might say, hey, in order for us to loan you money, we need to see a set of financial statements. So that would be another reason that a company would prepare financial statements. Now, the SEC, government regulators, over 4 days in October in 1929, the stock market crashed, and it lost 25% of its value in just 4 days. It triggered the Great Depression, and investors no longer had confidence in public companies. That's a big problem, because if investment dries up, just the economy grinds to a halt. So to regulate the financial markets, Congress passed the Securities and Exchange Acts of 1933 and 34, and in that they created the Securities and Exchange Commission. So usually if we're saying the Securities and Exchange Act, we oftentimes abbreviate that the SEC. College football fans, that is not the Southeastern Conference. But the SEC is. But that's another name for it, but not two different, the same acronym for two different organizations. All right, one group regulated by the SEC is publicly traded companies, and that's what we're focusing on here. And it's the SEC's rules that require these companies to prepare and publish financial statements. These are some common SEC reports, and these are reports that were actually filed by Lululemon here. We can see over here some titles: 8K current reports, 10Q quarterly reports, special disclosure, beneficial ownership, proxy annual report. And you can see that they have filed these. These are reports that have gone out in kind of in the second quarter of 2024, from June 12th of 2024 to March 21st, 2024. The 10K, that's the biggest one. It's the one that was at the bottom. That's the annual report, usually prepared 2 to 3 months after the end of each year, 60 to 90 days. It has financial statements. It has additional information about the business. We'll talk in a moment. It's usually pretty long. The 10Q, a quarterly report, is prepared 40 to 45 days at the end of each quarter. You would think it's prepared 4 times. It's actually prepared 3 times, because the fourth quarter just gets included in that 10K annual report. Similar information, financials, and then more information, but it's much shorter than a 10K. As an example, Lululemon's most recent 10K, their annual report was 88 page, but their 10Q, the government required quarterly report, was only 45 pages. 8K current reports, companies can have a lot of those. It discloses key events. If Lulu elected a new CEO, if it had a major problem or something like that it wanted to disclose, it could do that in a current report as well. We oftentimes will refer to this as the DEF 14A. It's the proxy statement, and this is information that is published so that shareholders of the company can vote on important matters. You get a variety of important information in there regarding electing the board of directors. It has information about the firm which is going to audit the company. We'll talk about that in a little bit here, as well as compensation of the executive officers. So when you hear about CEO salaries, maybe you read about those in the news or something like that, this is where that information is found, in the proxy. The proxy, I won't say that the proxy impacts investing decisions as much, but it has interesting information about the board, about the auditor, and about the execs. Now, the SEC, as we said, the Congress has established the SEC, but then they said, you know what, we got to do a lot of different things, so we need a group who's just going to focus on financial accounting rules. Well, they established the group called the FASB, and then the rules created by the FASB are GAAP, Generally Accepted Accounting Principles. So the SEC, that's a government agency. It has employees. FASB is a group of individuals. That's employees. GAAP is not employees. Those are actually rules. And financial accounting is the method of accounting followed by GAAP. Review question 3. To regulate financial markets, which did Congress create? 10K, FASB, GAAP, or SEC? Have any thoughts on that? Well, it's not the 10K. Okay, that's a form that's required. It's not the FASB. That was an organization that was created by the SEC. GAAP are the rules created by the FASB. SEC is correct. Congress created the SEC in the 1930s. Corporate governance just kind of means who is overseeing the corporation on behalf of the shareholders. Because the shareholders cannot all just kind of come together and manage the company themselves. With many public companies, you are going to see not just thousands of shareholders, but tens of thousands, hundreds of thousands, perhaps even millions of different shareholders for a public company. They can't come together and agree on things, right? So what they do is they elect a board of directors. Public companies, board of directors, I don't know, in the ballpark of 11 people, probably. I guess I didn't look that one up in advance, but if I said roughly, it's usually an odd number. So if there's a vote, that there's a tie-breaking mechanism, 9 people, 11 people, somewhere in there. These directors make key decisions. They appoint the CEO, they appoint the CFO, and then the CEO, the chief executive officer, and CFO, chief financial officer, they appoint other executives and managers. At Lululemon, Calvin McDonald is the CEO, Megan Frank is the CFO, the senior executives. Moving on, the responsibility for the financial statements, managers are going to prepare them. They then get audited for accuracy by a CPA firm. Now, when we talk about a CPA firm, it's a group of individuals who've earned the CPA certificate, Certified Public Accountant Certificate. I think there's about 650 active CPAs in America right now, the last time that I checked. The 4 biggest firms in the world are Deloitte, EY, KPMG, and PwC. Those 4 firms are going to audit most of the big companies that you see, although there's thousands of CPA firms across America. Lululemon is audited by PwC, and they actually pay PwC. Last year they paid $2.4 million to have their financial statements reviewed by PwC under a very structured and organized process so that investors would see that PwC stamp saying these financial statements are accurate and feel confident in investing in Lululemon. The CEO and CFO are ultimately responsible for the financial statements. Now, the audit process, the auditors have to be independent so that they're objective when auditing the financials. So PwC has to be independent. They can't own stock in Lululemon, as an example. The board of directors has a subcommittee called the Audit Committee. So Lululemon has a board of directors, right? They have a subcommittee called the Audit Committee, which is going to appoint the auditors, appointed PwC, and oversee the audit process. The government created something called the PCAOB to oversee the audit of public companies, basically watchdogs over the auditors to determine whether or not they're doing their job. And the PCAOB can be fairly aggressive in the way that they review the CPA firms and impose sanctions if they do not feel like the CPA firms are doing a good job of auditing the public companies. Now, why is auditor independence important? In 2000, the CPA firm Arthur Andersen was one of the premier firms in the world. I was working there at the time. This is before I became a prof, and they were receiving $25 million in audit fees and $27 million in consulting fees from Enron. I did not work on the Enron account. I worked for Andersen, as did close to 100,000 people. Most of us did not work on the Enron account. So this resulted in a conflict of interest. Could Arthur Andersen, freely comment on and opine on the fairness of the financial statements of Enron when they were getting some really rich consulting fees off to the side? There can be pressures, from management at Enron, as an example, putting on that were put on the firm Arthur Andersen, basically like, hey, you want to keep getting these rich consulting projects, you better make sure that that you give us your good stamp on our financial statements, even if maybe there's some questionable things going on in there. So there's definitely a conflict of interest. And Andersen signed off on Enron's financial statements, which had been falsified. Now, the government investigated, and then Arthur Andersen employees shredded key documents. Again, I was sitting in Minneapolis at the time. We had people down in our Houston office shredding documents under a government subpoena. Not a good look. Andersen collapsed. Enron collapsed. Enron key executives were sentenced to prison. Review question number 4. Who audits a public company's financial statements? Which of these looks like the right answer here? Who audits? Well, not the CEO and CFO. They're ultimately responsible for them. Not the managers. Those are the ones who prepare the financials. Not the board of directors. They're going to appoint the audit committee to oversee the audit. It is an independent CPA firm like Deloitte, EY, KPMG, PwC, or the thousands of others that are going to opine on the fairness of a company's financial statements, so that the public can see that and say, okay, I have confidence that these financial statements are materially correct. Now, financial statements, they can impact stock prices. The value of a publicly traded company is set by supply and demand of investors and how they feel the prospects of a company are going to be. How much do they think this company is worth? Analysts out there are estimating what the company is going to earn. And then they will post these predictions and on information services. Yahoo Finance is one of these. It's very speculative. It's constantly changing. Stock prices are. As of July 2024, Lululemon had about 125 million of shares outstanding. That doesn't change like day to day. That it can change over time as the company issues stock or buys back stock. But what does change is that stock price, $290 each. I drafted these slides a couple of weeks ago. I didn't even look to see what it's at today. I'm sure it's not $290. Okay, by the time you watch this presentation, the stock price is going to be different than $290. But based on that 125 million shares times $290 a piece, the value of Lululemon is about $36 billion. As of July, Apple has about 15.3 billion shares of stock. They were worth $229 a piece, making the value of Apple worth about $3.5 trillion. Most valuable company in the world as of July of 2024. Microsoft and NVIDIA were also pretty close. This is a stock chart for Lululemon. Now, as you can see, the line is kind of going down, which is not what you want. Shareholders often don't know how the company is performing on a day-to-day basis. They really don't know until the company issues their financial statements every quarter through a press release and then followed by a 10Q or a 10K. Shareholders are going to react. If earnings were higher than expected, oftentimes the share price will go down. If earnings were lower than expected, the share price will go down. If they're higher than expected, share price goes up. Lower than expected, share price goes down. On March 21st, 2024, Lulu released earnings, and the earnings were actually better than expected, but they also gave some commentary that the future was not going to be as good as people were expecting. It wasn't like it was going to be bad, but just not quite as good as expectation. So the stock price crashed. $478 per share. Then earnings came out, crashed down to $403 per share. Instantly decreased the value of Lululemon by about $9 billion when the accounting information was released. That's the big dip right there. Final review question there. If a company's earnings are higher than expected, which of these is true? Stock price will decrease, increase if it's a public company, decrease, increase if it's a private company, and it's not going to decrease if it's a public company. It would increase. Private companies generally don't have stock prices, so we're not actually going to see a change in stock price because there aren't readily available stock prices. So yeah, the answer is the stock price is likely going to increase if it's a public company. So final reminders, financial accounting, using GAAP to prepare financial statements. That's what we're really getting into for external users. There's 4 big financials: income statement, balance sheet, statement of stockholders' equity, and statement of cash flows. Companies are governed by the SEC, which created the FASB, which created GAAP to prepare financial statements. And financial statements and what they show are going to impact stock prices. Thanks for tuning in, everyone. We'll see you next time.